Hey everyone, welcome in to another daily editorial here on the KE Report. We're chatting with Marc Chandler. We're going to be talking and recapping some of the Fed statements and the Fed minutes from this week and diving a bit more into some currency moves, which that currency market, especially the dollar index, still very much mixed. You can argue it depends what time frame you're looking at, either in an uptrend for this year or maybe a top that was just put in kind of middle April. We're chatting with Marc Chandler, managing partner at Bannockburn Global Forex. Marc, just a quick recap of the Fed minutes, which I guess generally were hawkish, but really seems like the Fed is still just walking that line, saying they do want to cut rates, but they're not there yet. And then they throw the odd comment saying, well, if things really change, maybe they will raise rates. But we all know that really is not on the table. It's more looking ahead to rate cuts. Tie in what's happening here with what you read in the Fed minutes, Fed speakers recently, how that ties into what the market is pricing in, rate cut expectations for the U.S., please.
Sure, it was an interesting week, right? We had some stronger than expected data, and this follows a series of relatively weak economic data where the economic surprise models that people use are near 2-year lows. And so we did get that stronger than expected PMI, the flash PMI, which showed not only the best activity, the composite highest in 2 years, but also more price pressures. That was quickly followed by the FOMC minutes, and as you said, they seemed a bit hawkish, given that the outcome of that meeting and Powell's press conference, where he seemed to play down even the discussion of higher interest rates. So, what has the market really done? Well, if you think back to where we were, say, middle of January, the market was pricing in almost 170 basis points of cuts this year for the Federal Reserve. I don't know what planet we were on, but whatever it is, we're well off of that planet now. And as of where we're sitting here now, Friday afternoons talking, the market's got 33 basis points of cuts priced in for this year. And so what does 33 basis points mean? It means one cut, 25 basis points, still thought to be odds-on favorite scenario. And there's about a 1 in 3 chance of a second cut. And what's happened is that the 2-year U.S. yield, which is a good proxy for a medium-term view on Fed policy, had bottomed at 470. We tested that in April, and we tested it again earlier this month, and we are approaching 5% again. And so this backing up of U.S. interest rates, I had anticipated this when we talked last week, but I had thought they would give the dollar greater staying power, and instead the dollar has turned fickle here in the second part of the week.
Well, Marc, as it relates to the remaining cut that the market is pricing in, a lot of people are expecting something in September, but other people have mentioned if they did a September cut, it may be seen as political, and the Fed's gone out of their way to say they're not a political organization. People have mixed feelings about that. It's a polarizing conversation. But would it be a political signal to cut rates in September, or would it be wiser for the Fed just to wait until the end of the year and do it in December?
Well, I think that a lot of people are so sensitive, and maybe this speaks to the partisanship in the U.S. right now, but there's precedent. Several precedents for the Federal Reserve to change policy in September ahead of a November election. So I don't think that is political. I don't think it's necessarily political. I think it depends on the context. If the Fed were to be talking hawkish and all of a sudden cut in September without having the economic data behind it, I think you'd have a stronger case. But I think that we have to, the market sentiment has really, the pendulum of expectations have really adjusted. As I'm looking at the Fed funds futures now, I see the market pricing in slightly more than a 50% chance of a cut in September. The full rate cut, the full quarter point rate hike is not really discounted until you get to the very end of the year, the last meeting of the year, December 18th. So is the Fed, I think that really speaks to a couple of issues that you raised. One is people still see the Federal Reserve as politicized. I don't see it that way at all. I don't think that Powell or the Federal Reserve or economists in general, when they put on just a strict hat, I don't think they really care who wins. I think that what they're reacting to is economic fundamentals. Inflation has been more stubborn than people expected, including the Federal Reserve. And the economy has proven to be more resilient. And so I think it's on those kinds of case that the Federal Reserve had basically signaled that they were growing more confident at the end of last year, early this year, that inflation was headed towards its target. It's no longer that confident. Could it regain that confidence? Probably, but it's going to take some time, and by some time, several months. So I think that the idea of a September cut, the market has begun really pushing back against it and pushing out the first cut fully discounted to the very end of this year. And I think this really sets us up for more cuts that this monetary cycle that we thought was going to really get going this year doesn't get going till next year.
How do you balance that out with market moves then, Mark? Because in all fairness, everyone was looking at Fed rate cuts as being key drivers for the U.S. equity markets, the broad averages, and with the rate cuts continuing to get pushed off, not just in the U.S., but in a lot of other countries, markets have remained strong. So is this simply just a risk-on environment that could be the reason why the dollar's being held back from your expectations, even though we're not getting those rate cuts?
Yeah, I think that the reason we're not getting the rate cuts is partly because the economies are proving more resilient. And more resilient economies also generally should be good for companies who provide stuff, goods and services for that economy. And as you said, it's not just in the U.S. We've seen the Eurozone PMIs recover. Europe is enjoying partly an inventory, partly a trade economic recovery. Even though the Japanese economy contracted in Q1, the economy looks like it's doing better. We'll get more data next week, but we're seeing already signs of return to growth. The UK economy contracted in the second half of last year. It posted a strong gain, 0.6% in the quarter in Q1. And so, yeah, I think that leaving aside China, I think that generally speaking, the major economies have been more resilient than expected, and that might be helping stocks. But I think you're right too, is what else are we going to do with our savings? Remember how it works in the United States? People get defined contributions into their pension program. And what that means is that people have to buy stocks almost every week. As they get paid, money goes out of their paycheck automatically put into the stock market. So I think there's a steady stream of buying. And I think that we're still in that mode where people are buying dips. Even though some stocks seem to be very elevated, we saw some strong earnings, some strong guidance, and stocks we've had a strong rally in U.S. stocks. And also, until this week, really, European stocks have done fairly well also.
Well, Mark, we always like to get your thoughts on the currencies. You did mention the dollar there, but when you think about what other central banks are doing in the EU, in Japan, in Great Britain, how does that affect the lay of the land as far as the currencies and how they relate to the US dollar?
Yeah, so I think that when I think about what happened in Q4 last year, I think about what happened in Q1 this year, and I think that's not, in some ways, I want to say that what really drives it is U.S. rates. For example, in Q4 last year, global rates fell sharply. People were pricing in very aggressive central bank easing. The key was that people were pricing in easing of the Fed policy, and the dollar fell. As those views were adjusted in Q1, the dollar bounced back. So I think that if I look at the interest rate differentials, and of course that's what drives your forward rates, and that's one of the stories I think for me holding up the dollar is you as an investor are still paid to be long U.S. dollars. So I tend to focus much more on to explain the dollar's movement or to think about the dollar's movement, focusing on developments in the U.S. more than Europe or Japan. You can see this. Japanese raised interest rates this week for the first time in, I want to say it's like a dozen years. The 10-year JGB yield rose above 1%. So what? It's a watershed for them, but it doesn't really help the dollar it doesn't really help the yen. In fact, the dollar rose above 157 this week, basically making a new sort of say post what we think is intervention high. As I look at the dollar index, I drew a trend line connecting the end of December, the low from last year. We were down to about 101 and a half or so. Maybe it was December 28th, par 61. Draw that trend line off of that early March low, and that came into the mid-May low. And so that trend line, 3-point trend line, making it valid, right? It comes in next week. It begins right around that 200-day moving average, right around 104.40. And so I think if that level holds, I think that this down move in the dollar index, which, as you said, began middle of April from about 106.5, I'm looking for that move to be completed. And that's why I try to is like sketch out a view last week. We did get that bounce this week, but it's stalled here near the 20-day moving average around a little bit above 105. So I'm concerned. I really want us to go through that. And the next retracement I'm looking at is about 105 and a half. But so to me, that we stalled here both after a strong close yesterday, a weak move today. Part of me wants to dismiss it as just thin Friday activity, given the holiday on Monday in the UK and the US. But I won't become convinced until we can take out this high that we set yesterday near that 105.10 area.
So, Mark, any catalysts on the horizon that could change the direction here that is a mixed picture for the dollar, broadly in a range here? And again, depending what time frame you look at, maybe in an uptrend, maybe just put in a top. What sort of news, what sort of data could actually break this range-bound trade?
Well, we have a very light week as we enter the last week in May. The highlight probably will be not in the U.S. Eurozone CPI likely to tick up, but not sufficient to make people really doubt that the ECB will cut rates in that first week in June. Tokyo gives us the CPI, which is a great gauge for the national figures that come out several weeks later. In the U.S., we get the PCE deflator, and just given the way that the PCE is constructed, it seems that it's not going to reflect the softness that we saw in the CPI. But the next big report for the dollar, I think, is going to be the jobs data in that first week in June. And what I've noticed is that I tracked the Bloomberg surveys, and a week ago I suggested that Bloomberg survey showed 225,000 increased non-farm payrolls after 175,000 in the April data. And over the past week or so, as new forecasts have been submitted, that average has gone down to about 175,000. And so I think that'll be the next big thing. But I'm still thinking that the Eurozone is going to give us what I'd call as a hawkish cut. They're going to cut rates and then play down the likelihood that they're going to follow that up anytime soon, such as the July meeting. And we've already seen what's happened at the Bank of England. CPI came in a bit higher than people expected, than even the Bank of England expected. And the market has pushed back from an August cut now to a November cut. And so sterling is actually doing quite well this week. Closed, I want to say today, it's likely to close above 127. It had been previous resistance. Likely to close above it for the fourth time this week. Sterling well bid, partly on the back of that shifting expectations of Bank of England. But I think for the dollar, the next key number is really going to be the jobs report on June 7th.
Well, Mark, let's pivot over to the commodity sector. A lot of people listening to the show follow the commodities. There's been a general trend higher in almost everything for the last couple of weeks, really the last 2 or 3 months. But then this week we saw a lot of things roll over. Gold, silver, copper, nat gas all turned down this week after having some blistering moves the week before. What's your read on the commodity sector? Any particular catalyst driving things?
Well, I think that it's not a very homogeneous market. I thought to maybe begin off with the precious metals. I know everybody likes gold, especially as it made new record highs this week. And that was early in the week. As the dollar strengthened, interest rates rose, we saw gold pull back. But many people I talked to are still looking to buy gold on pullbacks, thinking that at some point the dollar will turn, interest rates will fall, and they think gold is a good expression of that. When it comes to oil, we did see oil prices. I'm looking at the high, and we saw what happened there. It's been struggling lately, partly on supply issues, but also demand. We fell to the lowest level in 2 months earlier today, around 76.15 on the July WTI contract, but yet we're bouncing back here nicely. We're going to close back above the 200-day moving average, which is around 77.55. So to me, it looks like we're still stuck in a range. We haven't really been able to close above 180 this month. Excuse me, that's $80 a barrel. We haven't been able to close above that this month. But I do think that today could be marking the near-term low. Maybe get another run at that, especially if all these economies that we're talking about, economies look like they're recovering. Next week, China gives us their PMI, and any sign of Chinese recovery should also be good for the industrial metals and oil.
What is your assessment of China? Because boy, oh boy, we get a lot of mixed news about China. Look, they were really struggling recently, but it seems like some of their economic data is turned, but also we're seeing their central bank step in and try to save the housing market, try to do a lot more on the easier side of things than other central banks. Where do you see China going?
Yeah, I think that the conversation about China is so politicized, partly because there's one camp that thinks we're in a Cold War. Another camp thinks that what's happening between China surrounding Taiwan this past week after the president was inaugurated in Taiwan. So I think that there's one camp that thinks we're in a Cold War, and that might be the optimistic camp. Another camp thinks that World War III has begun, thinking about what's going on in not only in Ukraine with Russia, but they apparently moved some buoys that were dividing territory, actually a river between Russia and Estonia. And so people are worried about Russia acting up. And of course, you still got this Middle East going on, Middle East struggle going on, and which is partly Iranian proxies. So I think that the optimistic camp says we're in a Cold War, and the sort of the pessimists say no, we're in World War III already. And I think that there are some voices that say the relationship isn't quite as bad as it was between the U.S. and the Soviet Union, but those voices seem to be shouted down quite a bit. I don't know what to make of it. I do recognize that if there's one thing that the U.S. political elite agree on, besides condemning the International Criminal Court, is that China is an enemy, and we not only need to block them from investing in the United States, building cars in the United States, which we allowed Japan to do. Remember in the 1980s, we didn't want them to be exporting so many cars to the U.S., but we were happy for them to use U.S. labor and U.S. Territory to build their cars, which they do to this day. We don't want China to do that. And so I'm afraid that the U.S. camp is really hardening its stance on China. And depending on how the election turns out in November, it could become more intense. I'm worried about that. I'm worried about the politicalization of the tariffs. In the U.S., we like to think that we're the best in everything. But when you look at our manufacturing sector, it's relatively small as far as number of employees. I want to say something on the magnitude of 12 million employees in the manufacturing sector. We're sacrificing quite a bit for them. If you think that we're going to slow down our transition from climate change, from solar panels and cars, because we don't want to get China, which basically has, because of the huge scales and what we think is overcapacity, they've been able to drop the per unit price. For example, they've got electric vehicles that sell for $10,000. And imagine if we had those in the U.S. But of course, you need a whole system with the rechargers and charging stations throughout the country and everything. But I do think that the rivalry between the U.S. and China is not going to go away anytime soon. That there is a genuine conflict of interests, and this will continue to find points of clashing, especially on economics.
Oh, yeah, it sure seems like this is continuing here. A lot of battles being fought on a number of different levels between the US and China, and it does seem like China's ahead in many areas. But hey, the US markets still do seem to be king, so the US has that in its back pocket too. Marc, thank you as always for your time. We'll chat again next week. I'll post a link to your blog, Marc to Market. That's where everyone can keep up to date with you, covering data points and market moves. Marc, I hope you have a great rest of your week.
Good luck to everybody.